Money and banking. We're going to look at the 2023 paper. So the first section is multiple choice, which I'll skip. We'll just quickly go to the second section, where we're going to look at choosing any three. So question number 2, briefly, with brief notes, explain the following: what inflation is, what liquidity preference theory is, expectation theory, and cost of money. So these is 4 marks. So we can explain each of these ones here. So what is inflation by definition? Number 2. So inflation is defined as what? A general increase in prices of goods and services. That is what inflation is. So inflation is just a general increase in prices and what? Of goods and services, which can lead to a decline in purchasing power. So it's commonly measured by the CPI, Consumer Price Index. Okay, moderate inflation is simply a sign of a growing economy. But if you have excessive inflation, it can erode the savings. Okay. So we have different types of inflation, although this is just 5 marks to expand it. What types of inflation do we know? And to add more to what you know. We talked about inflation, which is a general rise in prices generally for goods and services. So inflation, we have key points to know. There's moderate inflation, there is excessive inflation, there is um, also deflation that you need to understand. So in dealing with moderate inflation, there's a small amount of inflation, which is typically 2 to 3%, and is generally seen as a healthy economy is growing. Excessive inflation is when prices rise too quickly. So we call that hyperinflation. It can lead to significant problem in the economy. So the impact that inflation has is that it will affect what? The cost of living. So people may spend more on groceries, rentals. So if wages do not keep up with people's real income. So in terms of uncertainty with investment, when inflation is unpredictable or it's excessively high, it will create what? Uncertainty in the economy. So that's what inflation can do. Okay. So the other concept that we want to talk about is the concept of liquidity preference theory. What does this theory assert? What does it talk about? You've heard about this concept, liquidity preference theory. What does it talk about?
Yeah, okay. So I have two understandings of this. One from the perspective of financial markets, and the other from banking and finance. So money and banking. So
Mhm.
from money and banking, it's like uh, the notion that basically an economy is made up of two elements, currency in circulation
Mhm.
and is its deposits.
Mhm.
Yeah, I think it's deposits. Then from the film side, it's a little bit more elaborate. So I've always wanted to say, okay, in this case, which is the best solution to go with?
Okay, basically, it's a theory that suggests that interest rates are influenced by forces of demand and supply for money. So people prefer to hold money in its liquid form. Okay, so there are 3 reasons. That's what we call the transactions motive, which says that people in need of cash for day-to-day purchases and expenses. Okay, so they will prefer to hold money for the transactions daily. A precautionary motive under the liquidity theory is that people will keep cash for unexpected situations like emergencies or unforeseen expenses. And there's also speculative motive, which says that people hold cash in order to take advantage of the future opportunities. All right. So this theory actually argues that the higher the demand for liquidity, the higher the interest rates that would be needed to encourage people to lend their money instead of keeping it. We also have another theory, which is called the expectations theory. Okay, what is expectations theory? Have you heard of it? Expectations theory.
Yeah, it eludes me.
Okay, what does it talk about?
No, I'm saying I've heard of it, but it eludes me right now.
Okay, so the expectations theory is simply a theory that explains the term the term structure of interest rates. Okay, it suggests that long-term interest rates um, an average of the expected future short-term interest rates. Okay, so this is a theory that is so common in finance. It's used so much because it explains how interest rates on bonds, interest rates on different maturities are related. So the interest rates and expectations. So the theory really suggests that long-term interests are essentially an average of the short-term interest rates and the expected future short-term interest rates. So investors here will base their investment decisions basically on what they expect the interest rates to be in future. So this is how it works. If investors will expect short-term interest rates to rise in the future, then their long-term interest rates will be higher to reflect the anticipated increase. So this is so because when investors demand higher returns for locking their money for longer periods of time, they should in fact expect higher what? Um, higher expectations, higher expected returns, and the opposite. If investors expect future rates to fall, meaning low, the expected returns should be lower. So an example I can give is that if the current short-term rate is 3%, in the short term, you may expect the expected return to be 5%. Okay, so the long-term rate would be an average of these two. So that is the 5 marks that you're looking at. Then we also have the cost of money. What is this concept, cost of money? You've heard of it? When we're dealing with cost of money, basically, we're looking at what? The concept that refers to the interest rate or yield. Okay, so the cost of money refers to the interest rate paid for borrowing money. Okay, that is the cost of money, the cost of borrowing. Okay, so the cost of money is actually another term that we use, the cost of borrowing. Are we together? So when talking about the cost of money, we're talking about the yield paid for borrowing that money. Okay, you're borrowing money, so we usually understand that money that is retained has less costs, less interest compared to money that is plowed back. So the borrowers will need to be paid, the people borrowing will need to pay an interest on that. So the key factors that influence the cost of money, the inflation, the risk that is there, the time factor, and the policy and the policy that is there. So inflation will affect the cost of money because the lenders want to be compensated for the reduction in the purchasing power with time. Okay. And the other factor is the risk. So if you have high risk, okay, there's a higher interest rate that will be there. So companies will usually compensate the lender for taking on that risk. Then there's also the time factor. So time preference actually refers to the desire to consume now rather than later. So what is the impact that this cost of money has? So if you have high costs, so when the cost of money, which is the interest rate, is high, it will discourage people from spending. Okay, if they are low cost, so when the cost of money is low, the borrowing becomes cheaper, so people will likely um, invest and spend and stimulate the economy. So these are the elements that I wanted us to talk about. Then we go to the second question. Second question is asking that in 2021, Zambia faced an escalating inflation that led to an elevated cost of living among citizens. To address this situation, the Bank of Zambia was needed to act to save the day. So given the following, answer the following. Number one, how can the central bank respond to the dealing of high inflation? And name two direct and two indirect instruments that monetary policy uses and how they can use them to do the problem described above, and discuss the three functions of the central bank. So this is a very common question in money and banking. All right. So you've heard of the OMO system, right?
The what? OMO system?
Uh-huh. So the central bank
No.
is mandated to act on behalf of the federal government to use
Mm-hmm.
different ways in which to respond to high inflation rate. So one of the ways that
Mm-hmm.
the central bank will combat the issue of the inflation rate is number one, to
Interest.
increase interest rate. Okay,
Mm-hmm.
increase of interest rate. So by increasing the interest rate, what happens? The Bank of Zambia will make uh, borrowing more expensive. So they reduce consumer spending and investment.
Mm-hmm.
So this will lower the demand in the economy. So to help control inflation. So inflation is having um, an overly increasing prices. So sometimes prices will increase because everyone has too much money to be in circulation. So prices will go up. So the only way to do that is to tighten the circulation of funds in the economy by increasing the interest rates. Then by using what are called uh, open market operations, the OMO system. So the central bank can sell government securities like bonds. By selling these securities, they're actually asking for money from the general public in the open market. So they will remove money from circulation and will decrease the money supply. So it will cool down inflation. So sometimes it's a good thing when there's no money in circulation. People complain. It's just one of the operations that government uses to what control. They will withdraw money. By selling bonds, they're asking for money from the public so there's little money in circulation. Then sometimes they increase the reserve ratio. So banks have reserve ratios where it's like the minimum book balance. So if they increase the reserve ratio, meaning banks will have little money to lend out. So this indicates that money in circulation will be uh, little, then this will reduce inflation. The other intervention is through foreign exchange intervention. So if inflation is driven by depreciation of the local currency, the central bank can intervene in the foreign exchange market to stabilize the kwacha. So this can help reduce inflationary pressure caused by higher import prices. The other is inflation targeting. So the Bank of Zambia can adopt what is called inflation targeting policies, which are publicly committing um, to keep inflation within a certain target range. So this can influence expectations and encourage businesses to stabilize their prices. So this is inflation targeting, where they are going to target a certain range within which they all lie. Is that clear? So this is how government gets to control inflation. Sometimes they communicate um, the central bank will clear the communication channels to influence expectations or let the public know that they're committed to controlling inflation. So just this in itself can lead to better inflation expectations. The second question is asking us, um, mention any two direct and two indirect instruments that of the monetary policy and how they can deal with the problem of inflation above. Any two direct and two indirect. So one of the direct one I've mentioned it is the reserve ratio. Okay.
Mm-hmm.
So reserve ratio I've explained is simply minimum balance that the bank should have. So the central bank can adjust this by apportioning funds to commercial banks that they can keep not to lend out. So if Bank of Zambia increases that, it's a direct way in which commercial banks will have less money. The other one is direct controls by direct lending regulation. So Bank of Zambia can impose direct lending restrictions on commercial banks, like limiting the amount of credit they can extend to certain sectors. So this will reduce the supply of credit. So there are also indirect methods that the Bank of Zambia can use to control. Okay, I've mentioned one, which is the OMO system. Remember the OMO system, which I talked about, the open um, market operations. So
Open market operation.
this it involves buying and selling what security. So government can deal with inflation by absorbing excess liquidity by issuing bonds. Also, discount rate by lending. By the discount rate is simply the interest at which banks can borrow from the central bank. So if the bank decides to increase the discount rate, so it becomes expensive for commercial banks to borrow money. So that is another indirect way in which the federal government through the instruments can be done. So the indirect, we've talked about the
Sorry,
honesty
Colin, if,
and the
before you move on,
uh-huh.
did you say interest rates are indirect?
Yes, the discount rate which the government will use through the bank because banks are also allowed to borrow money from Bank of Zambia. So there's a
Mm-hmm.
discount rate which is the interest rate at which commercial banks will borrow from the central bank. So the Bank of Zambia will
Mm-hmm.
increase that interest rate. So inevitably, it will be expensive for them to even lend out. So people will borrow less. Okay. So the two
Mm-hmm.
indirect methods we talked about is the OMO and the discount rate by increasing it. The direct ones we talked about is what?
Direct, we spoke about what was it? I've forgotten.
The reserve ratio and what? Direct controls. And the reserve ratio,
Direct
just
controls.
give them, say, the minimum balance you're going to have is so much. Then
Mm-hmm.
also can impose what direct lending restrictions where they will limit direct, just tell them, so get this, you need to reduce supply of credit to this sector. This is a direct way. Okay.
Okay.
Yeah. Then um, what are the three functions of the central bank? So
Regulation. Mm-hmm.
Bank of Zambia has many functions.
Monetary policy. Mm-hmm.
Uh-huh.
No, please go
Okay, so the function of the central bank, there are many. So we've been asked to look at three. I can look at more than three. So the monetary policy, okay. So there are several functions that the central bank has. So let's look at them. Here are they. Number one, monetary policy implementation. So only the central bank has that function of um, monetary policy. So the central bank is responsible for formulating and implementing the monetary policy. It uses tools like the interest rates, OMO operations, and reserve ratio to control money supply. The second function is issuing currency. It's only the central bank that has the authority to issue a national currency, Kwacha in Zambia. So it ensures that there's sufficient supply in the economy to meet the demand and is responsible for designing, production, and regulation of these currency notes. So through the Bank of Zambia. So now that we have new notes, it's only the Bank of Zambia that does that. It's a banker for the government. So central bank is actually acting as a bank for the government. It manages government's accounts, processes payments, and manages all national debt. Additionally, it acts as government's fiscal agent for debt issuance. All right. Besides that, what other functions that the central bank has? It supervises commercial banks, manages foreign exchange reserves, and it is known to be the lender of last resort. What does it mean? We say it is a lender of last resort. Okay, so in times of financial instability, the Bank of Zambia acts as a lender, meaning it provides emergency financial assistance to central banks or financial institutions facing liquidity problems to prevent them from collapsing. So it manages foreign exchange reserves, meaning it's responsible for managing the country's forex. So it's because of the Bank of Zambia's mismanagement or management that we have exchange fluctuations. So as much as possible, the country needs more foreign currency like the US dollar so that we get back our dirty money, which is kwacha in the foreign hands. So it is the mechanism that the Bank of Zambia does to maintain forex or foreign exchange reserves. Okay, so is that clear?
Yes, thank you.
Okay, so now question number 4. Question number 4. Part 1. Okay. Part 1, we're going to look at this part. So answer the following questions. Suppose the reserve ratio is 10% and banks hold an extra 5% of deposits in excess, and consumers hold currency balances at about 10% of what they hold in deposits in banks. Suppose the Bank of Zambia makes an open market sale of 50 billion of OMO funds. Compute the exchange, compute the change in money supply. Is there an increase or is there a decrease? Okay, so here we want to calculate our money multiplier and also to see whether there's a deficit or there's a surplus. So what are we given there? What is our required reserve ratio? 10%. Okay. What is our excess
10%.
reserve ratio? 5%.
Mhm,
What is the currency deposit ratio? 10%, right? And the open market
mhm,
sale, which is 50 billion.
mhm.
Okay, so we want to first calculate the money multiplier. So the money multiplier, you've heard the term money multiplier. What is a money multiplier?
Yeah, I've heard it, but I can't put it in words. It's how basically it's a function of how money works.
Yeah, it's a
Um,
concept in economics which shows how that an initial deposit in the bank can lead to increasing what? The total money supply. There's a multiplier effect. So if a person deposits some money in a bank, the bank doesn't just keep it, okay? It is required to
mhm,
keep a certain portion, which is called the reserve ratio. So when you're calculating multiplier, it's simply 1 over reserve ratio. That is the formula. So in this case, we want to calculate firstly the money multiplier. So given the parameters that we have, we've been given a required reserve ratio, which is 10%. We've been given the
mhm,
reserve. So to calculate the money multiplier, 1 plus the currency deposit ratio, which is 10%, okay, divided by the required rate, the RRR required reserve ratio plus the excess reserve plus the currency deposit ratio. So calculate the um, we'll calculate the money multiplier. We want to see how many times if a certain amount was pumped into the depository of the central bank, how many times do go into circulation. So when you calculate that,
mhm.
meaning it will uh, grow 4.4 times. Now, that's not the solution. We want to calculate whether we're going to have an excess or we're going to have a deficit. So to calculate whether we're going to calculate the change in the money supply, we have been given an amount of what? 50 billion. Okay, we'll go to
Yes.
our question. So
Mhm,
remember, we've calculated our money multiplier to be 4.4. So we need to um, calculate. Okay, so the change in money supply due to the open market sale is 50 billion. So since the Bank of Zambia is conducting an open market sale, so it is selling government securities. So this will do what? Decrease the reserve. Remember, when government is selling
mhm,
bonds, we are reducing the reserves in the banking system. So this change in the money supply will be given as follows. Okay, so change in money supply. So the reduction in the circulation of money in the economy was as a negative, okay? Because it's going to withdraw money from circulation. So this is what we're going to have. So the change in money supply is equal to OMO funds times the multiplier. So our OMO funds are 50 billion minus times the multiplier 4.4. So we're going to get negative 220 billion. So this interpretation of this figure here simply tells us that the result will show that an open market sale will decrease money supply in circulation by 220 billion. So the conclusion is that the Bank of Zambia's open sale of 50 billion will result into a decrease in money supply by 220 billion in the economy. So this is just following the explanation that I gave, that one of the mechanisms that government through the central bank withdraws money to control inflation is by issuing what? Bonds. So there'll be a decrease in money supply definitely by what? By uh, by 220. So it's an issue of calculating the multiplier and applying to this figure there. Okay, is that clear?
Yes, it is. Thank you.
Okay, so we go to part B here. So part B reads, Zambia has been known to have high interest rates due to both structural and excessive government borrowing in the domestic market. There are some theories that explain interest rate determination in the economy, and one such theory is loanable fund theory. As a finance expert, explain to the president the loanable funds theory and how interest rates are determined. Okay, so what does the loanable funds theory explain? It explains the determination of interest rates based on demand and supply for money. So this theory is all about explaining the interest rates for the price of borrowing, and is determined by the forces of the supply of funds. So here are some of the key concepts that are there in this theory. Number one, talks about the supply of loanable funds and the demand for these loanable funds and the interest rate. So what does this theory talk about in terms of the supply for loanable funds? Number one, it says that the supply for loanable funds comes from savings. So when individuals or businesses take money to the bank to save their income, so those are the savings that are available in the financial system for lending. Okay. So now, if there's a higher interest rate, so those the savings become the higher the interest rate, the more the attractive the savings become. So individuals and businesses can earn more. So there's interest what earned and interest charged. So the supply to the banks in the financial system becomes attractive when people hear that once they save money, they're going to earn an interest. So people become uh, the high propensity to save. Then number two, the demand for loanable funds. So the demand for loanable funds comes from the borrowers, such as businesses themselves and individuals who want to make investments. So the demand for these loanable funds is influenced by factors like investment opportunities, government borrowings, and consumer credit. So if there's a lower interest rate, okay, it will be cheaper to borrow than to get from elsewhere. So to encourage people to borrow for investment. And the other concept is the interest rates. The interest rate is determined by the equilibrium point where the demand for loanable funds is equal to the supply for loanable funds. So at this point, the quantity of funds that borrowers want, okay, to borrow should be equal to the amount that savers are willing to lend. So when demand exceeds supply, means interest rates is more likely to be what? To be up. And the opposite, when supply exceeds demand, the interest rates will fall. So these are the concepts that this theory sets in simple words. So you're explaining to the president as an expert in money and banking. So you need to explain what the theory of loanable funds assets. Is that clear? So let's go through it
Yeah.
quickly again to say that when you're dealing with supply for loanable funds, what do we say? It becomes attractive for people to save money when the interest end is high. And conversely,
Mhm.
the demand for loanable funds becomes attractive when people borrowing money are borrowing at a lower interest rate. And in terms of
Mhm.
interest rates, we are told that what determines the interest rate is the demand for funds and the supply for funds. So if the demand is more than the supply, meaning the interest rate will be high. If the supply is more than the demand, the interest rates will be low. So that's what the
Mhm.
theory talks about.
Okay.
Is that clear?
And then, so when they are equal, that's when you have that term equilibrium rate of return.
Yes, that's where we have the term equilibrium rate of return.
Thank you.
Okay, so we end here for tonight. We'll continue tomorrow. Thank you so much for your time.
Thank you.